I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Adam Hamilton, CEO of ZealLLC.com. Welcome back to the show, Adam.
Hey, Jim. Thanks for having me.
The price of gold and silver taking a punch to the face the last few days. Is that a big concern?
Oh, man, it's been brutal. You know, as just a heavy gold stock and silver stock investor with huge positions, extensive positions, we just got hammered yesterday. Everything got stopped out pretty much. Brutal drop in gold, like 3.3%. Support broke. Is it a big deal? It's a big deal short term. It was, you know, everybody who had stop losses in their positions, including us, had to get stopped out, Jim. The main gold stock index, the Huey, was down 10.1% yesterday. It's almost any kind of stop loss you're running on a gold stock or silver stock trade got tripped yesterday, and I think that contributed to the selling. We run really loose stops, like 25%. I mean, any looser, there's not even any point having a stop anymore, but I run these super loose stops just in case something crazy happens to an individual gold stock. As you and your listeners know, sometimes there's geopolitical events. Sometimes a government moves to confiscate a mine, something crazy. So it's nice to have stop losses if something really wild happens. But all the stops triggering yesterday were just brutal. Just drove gold stocks down so hard, so fast. Technically, the uptrends in gold, silver, and the Huey were broken. I don't think that's a huge deal. It's a big deal for next week or two. It's really hurting sentiment. But these bull markets are really strong in 2016. What happened, I think, yesterday, Jim, was something I've written about for about 15 weeks now, cascading gold futures selling. The main thing that drives gold over the short term is U.S. American speculators gold futures trading. These guys have been excessively long for about 15 weeks now. Back in early July, their long positions, upside bets in gold, hit an all-time record high, and they've maintained around that 400,000 contract level ever since then. And these bets are really leveraged. You can run up to like 25 times leveraged with gold futures contracts. And so if gold moves against these guys' trades and they're fully leveraged, maximum margin, they have to sell it quick. And I think when gold broke below 1305 or 1300 yesterday, a lot of futures stops were set that level. And as soon as those stops triggered, those guys had to sell. I mean, when you're running 25 times leverage, a 4% drop in gold will wipe out 100% of your capital risk. And so there were a lot of futures margins calls, a lot of forced selling, both on the gold front and gold stock front. And, you know, the resulting carnage is what we saw.
Is this a case for maybe humans being in charge instead of robots?
Good question. That's interesting. I hadn't thought about it from that angle yet. You know, I don't think this was a machine trading thing. You know, I know margin calls can be automated and there can be forced selling from futures accounts, but if you go back and look at the history of gold, there's big moves in futures that are fairly common. I mean, every 6 months, certainly every year or so, we see moves like this. And when the futures traders get too long or too overweight on one side, either long or short, there tends to be a sharp reversal. And it just caught up with us yesterday. So I don't think it was a machine thing. It wasn't a shorting attack. In recent years, there have been a couple of shorting attacks, Jim. That's when speculators short sell just a massive amount of contracts in like less than a minute, like 20,000 contracts in 1 minute. And their purpose with that is designed to force a really sharp sell-off so that long side futures contracts have to be pushed down to their stops and sold, and that will exacerbate the sell-offs and the shorts will make money. But yesterday there was none of that. There was no crazy spike in volume over 1 minute or even 5 minutes. It was just a gradual, slow sell-off, cascading gold futures selling. And I don't think machines versus humans had anything to do with it. People just had these leveraged positions. They were heavily long, and the markets caught them on the wrong side yesterday.
Does this hurt the long-term outlook for gold?
Oh, no, not at all. It should be irrelevant long term. I mean, gold got knocked back down to 1270 or so, and that's back to May levels. And I don't even don't quote me on this for sure, but I don't even think it's a 10% correction yet from gold's early July high around 1365. Corrections in bull markets are common. Personally, I thought this correction was actually a high consolidation in gold was over at the end of August. There were a lot of technical reasons where it looked like gold was bottoming, and then in September there was a slight uptrend in gold, at least in the support side. And so it definitely damaged this new uptrend. It turned this high consolidation into a real pullback or correction. But as far as the bull goes, it's no big deal at all. This 2016 gold bull, about 30% is driven by investors buying mostly GLD shares, gold ETF shares, and they didn't buy anything in Q3. GLD's holdings were flat. And so once these investors return, probably when the stock markets roll over, as they're certainly overdue to, gold investment buying will come roaring back, and gold will surge. Gold should surge before than just on future speculators coming back. But it's no big deal at all in the context of a gold bull. But short term, it has really damaged sentiment, that's for sure.
Was the damage to gold bullion or to gold miners or both?
Well, they're so inexorably linked. If you study gold stock trading, they just follow and amplify gold. And so whatever gold does, gold stocks usually do it 2 times or 3 times. And that's exactly what happened yesterday. Gold fell 3.3%. That leading Huey gold stock index fell 10.1%. So, about 3 times leverage, 3.0 times leverage. That's not uncommon for a big sell-off. The investors haven't been buying gold for all of Q3. They kind of stopped buying at the beginning of July, and that's why gold has ground sideways since the beginning of July. And so these guys weren't heavily long. When their holdings consolidate over 3 months, that kind of tends to bleed off the excess greed. The future speculators, these guys are so short-term that, when you're running 20, 25 times leverage, you have to have just this incredibly short-term focus because, 1% or 2% moves in gold can be huge gains or losses for your capital risk. And so I don't think the future speculators care. They'll be back in as soon as they have an opportunity. I think a potential catalyst, Jim, will be this U.S. monthly jobs report Friday morning, 8:30 a.m. New York time, usual first Friday of the month. If that misses, gold's going to catch a big bid on just the lower odds of a Fed rate hike in the near future, and the future speculators will come roaring back in. One thing we don't know that I really need to know is whether this was long side liquidation, like were gold futures speculators selling some of their near record longs yesterday. I think they had to be, or were shorts piling on. We can't know that till Friday, 3:30 p.m., when the commitments of traders report for this week, current to Tuesday, the sell-off day was released. But that'll tell us a lot too about how fast gold will likely rebound. And so I'm really looking forward to that data Friday afternoon.
Some of the people I talked to yesterday said this is great news for people who want to acquire gold because it's much more affordable.
Absolutely, without a doubt. We got stopped out of a ton of positions yesterday. I run a 20-stock portfolio for our weekly newsletter, a 10-stock portfolio for our monthly newsletter, and we just got, almost everything got blasted back down to stops. But I actually wrote a weekly newsletter yesterday. Tuesday's my normal day for that, and we added 10 new trades in the carnage. We took that capital that was stopped out and just plowed it right back into gold stocks. It felt like a capitulation. It smelled like a capitulation. Total gold stock correction since that early August, is about 27% now. And that's just a massive, massive correction. It's hard to imagine much more downside. That's about as big as gold stock corrections get. Sometimes they can go over 30% in extreme situations, but early in a bull isn't an extreme situation. And so, it's a great buying opportunity without a doubt. But there's very few new gold stock investors right now. Everybody in this is a hardcore contrarian. The bull is only 8-9 months old at this point, and so it needs to get like 2 or 3 years old before mainstreamers start getting interested. And so I think everybody interested in gold stocks probably already had positions because they've been consolidating and correcting for a couple months now. So it's painful for everybody in this trade, but it's a great opportunity to buy if you can suck it up and fight your fear and get right back in.
One of my analysts told me that gold's probably going to do a nice V bounce. We don't know how low it's going to go, but when it decides to go back up again, he said, strap yourself into the seat because it's going to go straight up.
I agree. After extreme sell-offs, which yesterday certainly was, I haven't run the numbers myself yet, but I heard it was the biggest gold down day in 3 years. V bounces are really common after huge sell-offs, and so we should see a V bounce. Once again, I think that jobs report is going to be critical to how soon gold bottoms. The bottom might be today or tomorrow if that jobs report misses and future speculators come roaring back in. If that jobs report is a big beat, which will make future speculators think the Fed's going to hike rates sooner rather than later, Gold might go down a little bit farther, but it looks really oversold to me. Again, until I see that futures data Friday, we won't know for sure, but I'd be surprised if it goes much lower here, Jim. I know it was fashionable yesterday as an any big sell-off day to predict much lower gold prices before bottom, but to me it looks like it's bottoming, contingent on that jobs report, of course, and what the future speculators actually did.
Adam, well, for some reason I seem to have access to information you don't. My report says U.S. jobs, 154,000 new jobs created versus a 165,000 job estimate.
Sweet. That was actually this morning's ADP report.
Yes.
Yeah, there's a preview for the monthly jobs report. It's by ADP. Was it American Data Processing? It's that giant private payroll company in the U.S. That came out at 8:15 this morning. And that number moved gold a little bit. And you saw this morning gold went up a little bit after that report. Of course, it lost those gains a little while later because there's another report, the ISM Services Sentiment Survey in the U.S., and that came in way better than expected. And that made people swing from being, okay, the ADP jobs preview, private jobs preview is dovish, but the ISM Services report is hawkish. And so, gold doesn't tend to move much on the ADP report. That's always 2 trading days before Jobs Friday, the real U.S. monthly official jobs report. And so that's the one that's critical. ADP is kind of a throwaway report. People use it to try to game that big monthly jobs report, Jim, but it's never, I'd say never. I can't even say rarely. I don't remember a single time when ADP has moved gold big time because it's just kind of a preview for the real jobs report coming Friday morning.
Although if it's payroll, it's real. It's not government massage statistics. And as you know, governments find different ways to report things that always make them look favorable.
Oh, I couldn't agree with you more there. I think that U.S. monthly jobs report is very suspicious. There's a lot of things. There's a birth-death model. There's a small business where they just kind of guess the number of jobs created. I run a small business, a little company, and I don't have to report to the government right away if I'd hire someone, But I don't trust that number either, Jim, from a hard read on the economy. But from a market-moving standpoint, mainstream traders do, and that's all that matters. It's the perception of that number and how it affects markets, not the absolute veracity of those numbers, which are highly suspect. I think they're politicized, too. That U.S. Labor Department, which publishes that jobs report, is considered one of the most democratic departments in the U.S. government. People who are labor economists tend to be more Democrat, more socialist, and there was a lot of stuff leading up to Obama's last win back in 2012 where the jobs report looked way better than it should have been based on other data. And particularly the Jobs Friday was right before that early November election in 2012, and there was a big beat on that jobs report. And everybody thought it was total crap on Wall Street, like it didn't make any sense to anybody. And sure enough, it was revised away later. But people think it gave the incumbent Obama a nice news boost that final weekend when the undecideds, the swing voters, were making up their minds before voting for him. So, yeah, it's pretty interesting. That jobs number is highly controversial.
We'll have more with Adam Hamilton right after the break.
Gem International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the 4th largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond, recently discovered in Africa by a fellow Canadian junior. With a proven operator and finance team, Gem International trades on the TSX Venture Exchange. Symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're speaking with Adam Hamilton. Just before the break, we said so many U.S. government statistics get massaged, manipulated, and the same thing happens in Canada. They look back a couple of months and say, oh, well, we were overly optimistic. Well, if the numbers aren't accurate, why do you bother to release them in the first place?
I agree, and that's a really good question. I have a libertarian bent. I think we should have the smallest government possible, the least regulations possible, lowest taxes possible, the least burden possible from government. And a lot of this economic data doesn't even make any sense. I don't know why the government even tracks some of it. I don't know why we pay for it. And a lot of it's highly suspect. Even if the statisticians have pure intentions, which no doubt some of them do, there's definitely honorable people working in government collecting this data. There's so many estimates involved, Jim, and all these estimates are just so tinted by people's experience, by their political bias, by just all kinds of things. And when data's estimated, it's just total garbage. But putting on my speculator hat, all I care about is how traders react to the data, whether it's real, fictional, half real, partially made up. It doesn't matter to me. It just matters to me what the markets are going to do. how can I position my capital and help my subscribers position their capital to make money based on what the data is going to do. And so, yeah, there's two different parts of that argument, I think.
Do you find it frustrating that the ordinary person knows that old saying, buy low, sell high, and yet the tendency is to do the exact opposite? If everybody else is buying, they have to buy. If everybody else decides to sell, they have to sell. Why does that happen?
Oh, there's nothing more frustrating for me, Jim. Being in the newsletter business, my company's source of revenue is newsletter sales. We trade and do really well trading, but newsletter sales are a recurring source of revenue. Trading's a hit or miss thing, feast or famine. You have just amazing months and you have terrible months. And it's really hard to sell newsletters when things are bottoming because people don't want anything to do with a bottoming sector or bottoming stock. They put their heads in the sand, they get scared, they just won't put in the time to do the research and make the buy low. Conversely, when things are high and exciting, people are always like, oh, I want to buy this. It's gone up 100%, 200%, and by that time it's too late. Most of the gains have already been made. I think people who have been in the markets for years or decades, they kind of learn they have to suppress their own emotions. They have to fight their own greed and fear. Whenever you or I feel excited about a stock, odds are the run's already over. Whenever we feel terribly about a stock, odds are the selling is probably over. And so we have to fight our fear to buy. And I often tell our subscribers that the worse we feel, the tougher things look, the more hopeless things look, the better the buying opportunity is. I've written in the past how you almost want to be nauseous when you're buying. You want to buy into capitulation day like yesterday when it just makes you sick to your stomach to put your capital at risk, when it looks like it's just going to free fall into oblivion. And so being a speculator, you have to be a contrarian. You have to do the opposite of what the herd is doing, and that's just an acquired skill. It takes a lot of time, a lot of experience to be able to master your own emotions and to fight that herd mentality. But yeah, that's the reason most people don't make money in the markets, is because they buy when everybody else is greedy, which is buying high, and they sell when everyone else is scared, which is selling low. And buying high and selling low doesn't work too well unless you're shorting.
And of course, too, you have to look at what you're buying. If you're buying a product that no matter how low the stock goes is still going to be around, how is that a problem? Because you can buy more stock. And doesn't this promote averaging?
Yeah, definitely. Averaging is really useful. On a day like yesterday, a huge gold stock sell-off, no one can know the exact bottom during a correction. And so my strategy to buy during corrections is always to kind of gradually layer in. I buy over a period of weeks or maybe 6 weeks or maybe a couple months on the outside because I don't know when the exact bottom is going to be hit, and I want to straddle that bottom. So that's kind of like averaging in. You buy gradually. The worse things get, the more you buy. If things get better, you pull back on buying. And so, yeah, no one can tell the exact top or bottom, and so averaging is good because you're kind of playing the probabilities there. There's no sense putting all your capital in the markets at once or pulling all your capital out of markets at once at the top. And so it makes sense to gradually layer in and to buy positions over time. And I think one of the best applications for averaging, Jim, is physical gold and silver. Everybody should have a foundation of physical gold and silver in their own immediate possession underneath their investment capital. They should lay that up before they ever play in the stock markets. And, buying gold and silver gradually over time with just, a few percent of your monthly paycheck is just a fantastic idea because over time it's going to go up. The central banks are printing money like crazy. Gold and silver supplies aren't growing by more than 1% a year or so from mining, and so averaging into gold and silver physically is just an incredibly good strategy for investors, the core of every portfolio.
Also, too, I think with the price of gold, people were waiting for the equity markets to take a big plunge. Of course, that usually boosts the price of gold, and that plunge hasn't happened yet.
That's the main problem with gold all summer, I think. As I mentioned, in the third quarter, there's been no net buying of GLD shares, differential buying by American stock investors. And if you look at first quarter and second quarter gold demand this year, Jim, total global gold demand, 81% of first quarter total global gold demand growth, and almost 94% of second quarter total global gold demand growth was accounted for by increases in the American GLD gold ETF's gold bullion holdings. So this entire gold bull has been driven by American stock investors moving into GLD shares as a proxy for physical gold. And they didn't do that in the third quarter because we had that Brexit sell-off in late June, but the stock market just roared back right after that in hopes that central banks would do something and make everything good again, paper it all over. And then the stock market surged to new records. The S&P 500 hit a series of new record highs in July, and gold moves counter to stock markets. Gold investment demand thrives when stock markets weaken. And as you said, since stock markets have been so high and lofty in recent months, gold demand has waned dramatically, and that's why this gold bull has stalled out, because as long as stock markets are high or near records, people perceive no need to diversify into gold, which moves counter to stocks. I think that's terribly wrong. When stocks are high near records is when you want to buy gold, because that means their probability of stocks falling is the highest, but people don't think that way, back to the contrarian thing.
The British FTSE 100 index hit a record high yesterday. I guess maybe because the pound is at its lowest point in 30 years, so perhaps if you're an outside investor, British products look pretty good.
Yeah, absolutely. The irony of the whole British market thing is just fascinates me. I mean, I'm sure you and your listeners remember back in mid-June, people were talking about the Brexit, and the financial commentators were like, oh, it's going to be the end of the world for Great Britain. It's going to go into depression. It's just going to fall off the face of the earth economically. It's going to be so terrible. And, the British stock markets have been thriving, some of the best in the world. The British economy has been doing great. It hasn't gone into recession as everybody thought it would, let alone depression. The Bank of England, it's tried to do some easing, but it really doesn't have any justification for it. So at every meeting, the guys are like, well, maybe next month, maybe next quarter we'll ease, but right now things are okay. And so it's just incredibly ironic how the Brexit thing had the totally contrarian result compared to what everyone expected leading into that vote in late June.
Well, yeah, the boss of the Bank of England, Canadian Mark Carney, predicted all kinds of doom and mayhem. It didn't happen. But how accurate have central bankers been over the last 20 years? Oh,
terrible. I mean, they have the worst track record of anyone in the markets, I think.
If they were putting their own money in the markets, maybe they'd think differently.
Oh, without a doubt. Yep. Yeah, central banks are the biggest problem in the markets. They're so distorted. I mean, this is pretty much universally believed amongst the hedge fund community in the United States, and I'm sure the rest of the world. These markets have been levitated, inflated, bond markets and stock markets, by extreme central bank monetization of bonds and pushing interest rates to zero and even negative in Japan and Europe. And everything's so distorted. No one knows what a fair price is in anything, because if all the central bank easing reversed, or if they started tapering QE or raising rates, the markets would probably collapse, stocks and bonds alike. And so everything's fake, everything's fictional, everything's artificial. It's really frustrating for a lifelong student of the markets like me, decades of trading experience, and everything's just a central bank fiction. So none of the old trading, none of the cycle stuff is working right now. I think it'll reassert itself and will work, but for now the whole thing is just a central bank show. Interesting note in that, Jim. I saw an interview on CNBC a couple days ago by the Morgan Stanley's chief global strategist, Ruchir Sharma. And his team did some research on FOMC days. There's 8 days out of the year when the Federal Open Market Committee, the Federal Reserve's policy guys, make a decision, right? Eight trading days a year at 250. This Morgan Stanley found that since January 2008, 60% of all the gains in the S&P 500 came on FOMC days. They average gains of 0.49% compared to plus 0.01% for all other days, so 50 times as great gains in FOMC days as every other day combined. I mean, it's just ridiculous. These markets are a total farce, totally artificial, so hard to trade.
Yeah, Janet Yellen burp saying people buy their sell their GM stock.
It's ridiculous. It's so frustrating. You study the markets, you build up this knowledge base, you trade, and central banks say one thing, and the markets go just crazy off in a wild direction for a day or two before they stabilize, and compound over time. It just made the market so fake.
How does that make you feel as an investor? You do want the most solid, accurate numbers you can get.
It's mind-bogglingly frustrating. I can't even put it into words, Jim. Every day of my life I think about this. I talk with people about this all the time. It's just unbelievably frustrating. I think about the Bible talking about honest weights and measures, how important that is for commerce. And with the central banks distorting the money supplies and interest rates, no one has any honest weights and measures. No one knows what anything is worth. We trade these markets. That's one of the reasons I'm so bullish on gold and silver and their minor stocks, is because everything's fake. There's been so much money, fiat money, created in the past, since the stock panic. And I think that as that comes home to roost and as reality starts to reassert itself, the precious metals are going to do really, really well. But it's just mind-bogglingly frustrating to have to deal with all this central bank manipulation of both markets and sentiment.
Should you have a mix of gold, bullion, and miners in your portfolio?
I think so. I think once again, if you're a new investor, it's important to lay up a foundation of physical gold and or physical silver first. 5% to 10% of your investable assets. And once you have that, that's kind of like your ultimate insurance policy. If markets are closed, if all kinds of things can go haywire where you don't have access to financial account type stuff. After that, I think gold and silver stocks are the best investment in the world right now. Everything else is so high, so artificially inflated. Historically, if you look at trailing 12-month price-to-earnings ratio terms in the U.S. stock markets, the S&P 500, bubble territory has been 28 times, Jim. And at the end of last month, they were trading at 27 times. A simple average trailing 12-month price-to-earnings ratio of all 500 S&P 500 stocks. I mean, we're right at bubble territory, right in the cusp of a bubble, thanks to central banks. Yet, we're still in a secular bear. Technically, it started back in 2000. Stock markets should be trading at 10 times earnings at this point in the market cycle, on the way to 7 times, not at 27 times. And I think gold and silver, and therefore their minor stocks, are one of the few things that can go up when the central bank inflated bubbles pop or deflate gradually. By gradually, I mean over a year or two, not a super long time. But it's the only thing that makes sense to me. It's the only thing cheap, only thing unloved, only thing relatively low.
I saw someone say, I don't know if it was Google or Amazon, but right now they're so overpriced it would take you 300 years to get back your investment.
Yeah, it's crazy. Those PE ratios of the tech stocks, some of the big tech stocks are just insane. And I've never understood that. I've always been a value guy. I've always wanted to trade stocks that or invest in stocks that have reasonable price to earnings ratios. If Amazon is trading at 300 times earnings, you're right. If their earnings don't grow, it would take you 300 years just to recoup the stock price you paid to your earnings. That just doesn't make any sense at all to me. And tech investors always make the case, well, these companies are going to grow so fast that they'll grow into their PE ratios, and therefore they won't be so extreme. Sometimes that works. Oftentimes it doesn't. I definitely wouldn't do it. I think it's way too risky, but obviously a lot of mainstream investors love the super overvalued tech stock realm.
Do you look overseas to places like India where Apple's had a hard time penetrating because Apple products tend to be the most expensive, and India, even though their middle class is growing, they don't have the kind of cash that we have in North America?
Oh, definitely. It's I think the big U.S. tech companies are going to have a tough time selling into overseas markets. There's obviously the elite 1%, 2%, 5%, whatever, who can afford these American products, but the vast majority can't. And unless the U.S. tech companies make some lower spec products, some less expensive products, they're going to have a tough time penetrating China and India to the middle class or even lower classes, without a doubt.
Well, I understand that Apple is coming up with a line of 10 cheaper items. I'd like to see those on sale here.
Absolutely, yeah. I love Apple's products like everybody else. Stock is intriguing because it's trading like at 12 times earnings. It's really cheap, but the whole thing is an iPhone company. 2/3 of its sales or something come from iPhones, and is that market saturated amongst people who can actually afford a $700 cell phone? I don't know. It's not my wheelhouse, but I've never invested in that stock. I regret I didn't invest in that stock, but I hate doing it now. And we're looking at tens of millions of phone sales a quarter to sustain this kind of revenue and these price to earnings ratios. It's hard to imagine it lasting, especially if stock markets roll over and we go into recession in the first world and people tend to be a little more careful with their money. I mean, I think a 3-year-old iPhone works pretty well for most people. They probably don't need the latest and greatest every year. So it'll be interesting to see how Apple fares when the economy turns south.
Yeah, if Apple is relying on me to boost their sales, I still have an iPhone 4. It works terrifically well. Why change? And the fact that they got rid of the earphone jack, well, that means you have to buy $300 earbuds that are most likely to fall out of your ears within the next 3 or 4 days as soon as you bump up against somebody on the bus or on the subway.
Yeah, I hear you. All our old Apple products in my household work well as well. I've got an original iPad, the very first Generation 1 iPad. It works great. I also have a brand new iPad Pro, just released a few months ago, and probably 10 iPads in between because I use them all the time for work and for various things with our family. But yeah, the old products work just fine. They do the job.
They put in quality.
Yep, well, good stuff.
I mean, whatever happened to Sony? Sony used to be known for its quality. No one talks about Sony anymore at all.
Yeah, I don't know. That's a good question. It's amazing. My little personal experience, I've had multiple Sony products fail, and some of these are really high end, like $4,000 televisions fail after like 2 years of moderate use. I'm not a big TV guy, and I've had receivers from Sony fail, and I don't know if the quality's there. And maybe if the quality's not there, they just don't have the reputation of being a great manufacturer anymore. And maybe my experience is a total anomaly. Maybe I just got bad luck. But
no, you're absolutely right. Sony televisions, great picture, but they fail sooner or later. Whereas I have this really old Canadian-made Electrohome television set, it just won't die. The thing's 30 years old.
That's awesome. I sure wish they made stuff like that was durable. I think a lot of people would be willing to pay more for durable products with, military grade, like transistors, whatever blows out in those things, resistors. Talking about that, there's that recent story, Jim, about Samsung washing machines exploding. Like in the spin cycle, they come apart physically.
Yeah, they're made out of Samsung phones.
But, I wish you could buy durable products. I hate buying durable goods like a washing machine, have it fail after 2 or 3 years. It's so frustrating.
It's all made out of plastic. That's the problem. You take high heat and plastic. Some reason plastic doesn't like being heated up a lot.
You'd think the engineers could figure that out and decide that it's not worth the cost saving to have the bad publicity of stuff failing too soon, especially big ticket purchases like TVs or washing machines or things that people think a lot about, and when it fails they're really upset about.
Well, go back to Toyota and their sticking gas pedals. They were told when they laid off all of their senior engineers who were obsessed with quality that this would happen to them. And 7 years after that big layoff, they started getting all these technical glitches because quality wasn't job number one anymore.
Yeah, I guess you get what you pay for, whether you're manufacturing something or buying something, and it's really unfortunate. I think there'd be a big market for durable, really good products. They're a little bit more expensive, but they'd last a lot longer.
Well, that's what people say about goods made in Canada. Very reliable. They don't use the cheapest piece of metal or the cheapest piece of plastic. They put something in that's going to work for a long time.
That makes sense. I wish more, domestic companies, American, Canadian, could thrive in these markets, rather than people just buying the Asian stuff, which may be good quality, and a lot of it's probably not good quality.
Well, in Germany, for example, the attitude it was that if you buy a Mercedes-Benz, you have no reason to buy another car in your life. It's expensive, but it'll stay together.
Wow, that's just unheard of today.
Well, cars today do stay together a lot better than they did back in the 60s and 70s when built-in obsolescence. I don't remember any new American-built car back in the 60s and 70s that didn't start to rattle within a year. Now that wouldn't be tolerated.
Yeah, the new cars, they ride nicely. They, you don't have the rattle issues like you said, and so there's definitely been progress made. But
but other things are pretty cheap.
Yeah, any of the consumer appliance stuff, any of the consumer stuff, period, just seems pretty flimsy these days. It's really unfortunate. Look
at the attitude towards computers. If it breaks, you buy a new one. You don't get it repaired.
Oh, totally.
And yet that repair...
$700 phones, too, which is surprising, Get a new one if their screen breaks rather than replacing the part.
And I know the attitude is it costs so much to get your computer repaired, you might as well get a new one. But in my case, my repair was almost free. So
nice.
I didn't regret that.
Almost free.
Yeah, well, they just needed to replace a little part. A fan, was turning too slow. It was overheating, so they changed the fan for $30.
Nice.
So not everything has to be thrown out and redone. And if you want more memory, you can just add more memory, You don't have to go out and buy the whole new computer.
Totally.
So sometimes I think one of the reasons things cost a lot more is that we're just a little too hooked on convenience. It's easier just to buy a new one than to find somebody reliable to fix it.
Definitely. And fixing can be really expensive, too. I had a washing machine fail one time, 5 years ago or so ago. I think it cost me $200 just to get a guy out to my house to look at it and tell me it had failed, and it's just a lot of money compared to $500-600 for a new washing machine. And, if repairs are too big a percentage of the cost of the new equipment, people are just more likely to go to the new one and be done with the hassles of the old one.
And yet, the difference in a new washing machine, really, does it have to be computerized? They work perfectly fine when you just turn a manual switch.
Oh, totally. I think there's a brand, Speed Queen or something, that uses all mechanical controls. My parents got Speed Queens, and they just love them because of that. There's no computerized stuff to fail. Everything's mechanical and simple and bulletproof, made for laundromat-type use. And but they have like a home version of their commercial-grade machines, and so there's definitely a market for that kind of thing.
And that's probably what's wrong with the Samsung washing machine. It was built to fall apart in a few years, so you would buy a new one.
Wouldn't surprise me.
Adam, we always seem to end up talking about the strangest of subjects, but at least I know one person talking is knowledgeable, and I know it's not me.
You're way too kind, Jim. Thanks so much for having me. It's great talking to you this morning.
Thanks for being on. My guest has been Adam Hamilton, CEO of ZealLLC.com. You're listening to HowStreet.com radio. You can find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions for the show can be sent to info@howstreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.